morning, and welcome to the Brazilian American Chamber of Commerce's webinar entitled The Unintended U.S. Tax Resident. I am John Welch, the Executive Director of the Brazilian American Chamber, and on behalf of the Chamber, we wish you all health and happiness in this difficult time.
Countries don't tax you because you're a citizen of that country or a green card holder equivalent, no matter where you live in the world, which the U.S. does. But they also have a pretty year-by-year cut and dried test of if you're in that country for 183 days in the year, you're a tax resident.
Let's talk about how the substantial presence test is calculated. It's a pure day count test. So the first question is, what is substantial? Under U.S. rules, it's a math problem. First, if an individual's in the U.S. for 31 days in the current year, then you look at their presence in the U.S. over a 3-year period, with each year being weighted differently. So the present year, you count 100% weight. The year preceding the current year, you count a third of the days, and the year preceding that, it's a sixth of the days. So
yeah, you can overstay from a tax standpoint on a tourist visa. You may not be permitted to be here from an immigration standpoint, but too bad. I mean, the tax and the immigration are separate issues. So you can become an income tax resident even on a tourist visa.
If you're a U.S. tax resident for the current year, you're subject to U.S. income taxes as if you're a U.S. citizen, which means you're required to report and pay U.S. federal income tax on your worldwide income, regardless of source, including wages, capital gains, dividends, or in my client's case, the exercising of stock options, even though they were earned by him pre-immigration for a job that he no longer held.
And you also will pay U.S. tax rates unless you have a treaty, which Brazil doesn't. So that, for example, a U.S. tax resident would pay up to 37% on Brazilian bond interest or on dividends received from a Brazilian company. And that's pretty harsh news for Brazilians who are used to depending on that income at a much lower tax rate.
But sometimes when you're a tax resident, sometimes what's even more complex and more onerous than the paying tax and reporting the income is the reporting of non-U.S. assets. As a U.S. tax resident, regardless of whether you are paying U.S. tax or have any income to declare, you must report your details of your non-U.S. bank and foreign financial accounts, including the location of the account, the highest balance in that account during the year, the account numbers. And failure to report this information can result in a $10,000 penalty per an account. So reporting is really
and it's not just accounts. There's certain assets. For instance, if you hold non-U.S. real estate in a holding company, which you might commonly do with your Brazilian real estate, you're supposed to report that as well on a different form than the form where you report your accounts. And that account reporting, which you may have heard referred to as an FBAR, which is a foreign bank account report, requires you to report any account, the balance of 10,000, average balance of 10,000 during the year, not just that you own, but that you might have signing authority over. So if you've got signing authority over an account for a company in Brazil, you could end up having to report that. So it's, I mean, really the taxation is not as onerous as finding yourself a U.S. tax resident having to comply with our reporting of foreign assets and accounts.
And the last thing I want to mention on this is that, as Christina alluded to, it's not just bank accounts, it's any foreign financial asset. So it could be shares held in non-U.S. companies, which you need to report the company's financial information and ownership information. So there's lots of disclosure and no privacy.
But even if you hit the the substantial presence test like our guy Fabio did, there are certain rules that allow you to exclude days from the number. And if you exclude days from the number and you don't meet the substantial presence test, you are just not a U.S. resident, and none of what we described applies to you. So one of the exemptions that's been around for a long time is if you traveled to the United States and you planned to leave, but you got sick while you were here, there is a form that you can file, and you're allowed to exclude an unlimited number of days, provided that you can demonstrate that you plan to leave, but you're unable to do so because of a medical condition. This year, when people were stuck here due to COVID, not because they had COVID, the IRS finally provided some relief to people. I mean, if someone got sick with COVID here, they could rely on the medical exception, but what about if you were just stuck here, you couldn't travel, but it was due to this illness? So the IRS came up with this exemption that's just for the 2020 tax year. And that'll enabled you, whether you're sick or not, to exclude up to 60 calendar days from your day count test. But that exclusion period needed to be between and including February 1, 2020 and April 1, 2020, when the IRS said the most severe travel restrictions were in place.
If you're going to take any exception, you need to actually file something to tell the IRS you're taking that exception. But if you don't need to take an exception because you're not a tax resident, then there's no filing necessarily required unless other circumstances exist. So the next exception that does require more filing, a different form, Christina is going to describe, which is the closer connection exception.
Yeah, so the last two exceptions I described are a way to back out days from meeting the substantial presence test. This one is to get out of the substantial presence test altogether by saying that even though you had a certain number of days here, you're not a U.S., for subjective reasons, you're not a U.S. tax resident because you have closer connections to another country. Now, this one you can only use if you were in the U.S. fewer than 183 days. So if you're 183 days or more, this one's not available to you. If you're from a country that has an income tax treaty with the United States, you still have one more option, which is to use your treaty tiebreaker rules, which are substantially similar to this substantial presence tense exemption by proving factually that you have more connections to another country. But Brazil does not have an income tax treaty with the United States. So for Brazilian, this is the last stop in terms of getting out of being a U.S. income tax resident. I do a lot of pre-immigration work with Brazilians coming here, and I honestly didn't have one who moved here during 2020, but there's often a situation where you've resigned your Brazilian tax residency formally, but the year you're planning to move here, you don't have enough days to be substantially present here. So in theory, you are a tax resident nowhere. We don't like you being a tax resident of nowhere, but typically my clients have either moved here with a company or to make an investment here, so they will report their U.S. source income in the year they've moved here, but they don't have to report and pay tax on their worldwide income because they haven't been enough days here. And so when someone's planning to relocate here, you sort of want them to manage their prior 2 years days in the United States, not just the year they're going to move in.
State tax residency, it's not a pure day count like it is for the federal government. As you may know, the state governments have their own income tax residency rules, and they pose their own income tax separately from our federal government. They're not required to follow the federal substantial presence test, and they make their own rules or laws as to what length of presence or other factors that may establish residency. And for example, New York State will declare someone a tax resident if they're considered domiciled, which I'm going to describe in just a minute, in New York, or have a permanent place of abode, which I'll also define in New York, and are in the state for more than 184 days. So those two tests, domicile or permanent place of abode, are different than the federal just pure day count of substantial presence. So before I define the terms, why does this matter is New York State taxes their residents on worldwide income at a top rate of 8.82%, and New York City taxes its residents at a top rate of 3.876%. Whereas New York taxes non-residents on only New York source income. And New York City doesn't tax non-residents at all. They only tax individuals who are considered resident in the city. Domicile is the place that you intend to have as a permanent home, where your permanent home is located, and the place you intend to return to after being away. For example, if you go on vacation and you usually return home after a vacation, or a business trip, you return home. So it's whatever place that you return to after being away. Another thing that they look at is what they call the teddy bear test. And it's basically where you keep your nearest and dearest items. You tend to keep those items in your home, not in a vacation home or a second home. And a permanent place of abode is a residence that you permanently maintain, and you don't have to own it, you could lease it. It just has to be a place where you permanently maintain it and that you can live. So once established, your domicile will continue to be New York State and New York City unless you abandon it and move to a new location with the intent of making that new location your fixed and permanent home. So you actually have to move and make this home, this new location be your home. And you're going to have to be able to prove that upon audit. You can't just say, well, I've left.
Well, thank you, Christina, and thank you, Lisa, for a really great discussion and quite exhaustive too. We have a couple questions, however. Let's start with the first one, and this is a very specific one. And if you answer it, please, it's probably useful to go over it again. The question is about how a day is counted. They're counted as 24 hours. Now the question is that from midnight to midnight, or is it from the time you set foot in the U.S. or wherever it is you're counting these from, or New York, for example? Or do you have to exclude the travel dates? The question on how you calculate these things.
I think it's an hour here, right? I mean,
Yeah,
you have a partial travel date.
Yeah, there's no partial travel dates. If you're here, there is an exception that if you fly into an airport and you're waiting to, you're flying out of the country, waiting to transfer planes to fly to out of the country again, they won't count that as a day. But you can't. I have a client that came into the city, had dinner, and then went back to the airport. That they'll count that as a day. So it's only for changing planes is that day not going to be counted.
Right, coming from one foreign country, going to another foreign country, you just have a connection through a U.S. passport, airport.
I have dual citizenship. I have a private retirement account in Brazil that I stopped depositing money into, but I also haven't have any income from it yet. Where should I declare it, or should I even declare it?
So it's a Brazilian retirement account, right? And he's a U.S. I assume this person's a U.S. citizen, so it should definitely be declared. If it's over the minimum reporting limits, which I'm assuming it's $10,000, it is, that it should be declared here. If you're a U.S. citizen, you're declaring regardless of where you're physically located. There's no escaping reporting and paying tax on income as a U.S. citizen. It's one of the benefits of citizenship.
Are there any other items or situations in addition to the medical conditions that you went through that you can exclude for the calculation of the substantial presence test?
There is, there is one other exception that I'm thinking about. If you're in the U.S. For less than 10 days in a continuous trip, you're allowed to exclude that one trip up to 10 days. So with my Australian guy who was here for 30 days in January, he couldn't exclude that. But if he was only here for 9 days, I could exclude those 9 days.
It's interesting that the IRS can get downloads from a foreign account. How do they even know you have an account in the other country? It seems like you have to disclose it, which I can answer. Yes, you have to disclose it if you more. You said that are over 10K. What if you forget to disclose it the first year after you've opened it up? That's a good question. I
just want to go back to the beginning part of his question. There was a little law passed under Obama called FACTA. And what FACTA basically said is to the foreign banks, if you want to do business here, you got to tell us who your account holders are if they're US citizens. So many foreign banks, or pay penalties, many foreign banks said, forget this, and they threw a lot of US citizens out because they didn't want to deal with the reporting obligations. So, and then what the US then did is they went into a lot of agreements with the foreign countries and said, if you have a U.S. citizen, you got to tell us who's in your banks. So it kind of broke all the secrecy rules. So that's how the U.S. government knows. There's a lot of information going across the borders.
And the U.S. only, of course, being selfish consistently, only cares about getting U.S. taxpayers. So the agreements are very one-sided.
Yeah.
So the U.S. would only tell the other country if they had an account in the name of a, say, Brazilian individual or Brazilian company. I mean, how many clients have an account in the name of a Brazilian company or Brazilian individual? But I think there are still cases, though, of people who got green cards or something long ago and far away, and they never reflected that on an account opening application. And so they're just never in the system as a U.S. person.
But the other part of the question was whether you forgot to report. That happens all the time.
Yeah.
I have many clients that happens to. The question is whether you willfully forgot to report or you were non-willful. And so, if you're willful, then it could turn into a criminal act. So we won't even approach that. But non-willful, if you get right with the system, generally you'll be fine in terms of just get your reporting up to date and make sure that any income reported in those accounts is being reported in the U.S.
But once you find out that you should have, and we don't know who you are, but once you find out you should have, then you really do need to do something, because once you find out you should have and you don't, now you're becoming willful. And it's perfectly, I have a lot of clients, they don't work with Lisa, I send them to Lisa afterwards, but their accountant didn't know. And so they can say, I relied on my accountant. It's really nice if the accountant will cop to that, who should have known I'm not a professional. And so I shouldn't have penalties. And a lot of this reporting, you're not going to owe tax. There was no tax involved. So you just want to beat the penalty on it.
Okay, this is similar but the other way around. If you have assets in Brazil, and in this case, property, which you excluded from, except one that's held in a trust or some other type of special purpose vehicle, but no income or gain, should you list the property in the U.S. as well? Will there be any taxes from the U.S. federal government?
If you own land, let's just use the land as an example, that's not income producing, it's not held in a foreign entity of any sort, then there's no reporting. Or if you own a home in Brazil in your own name, and it's not in any type of entity, trusts, corporation, anything, then there's no reporting unless it's income producing.
Yeah, did they say it's in an SPV or not in an SPV? The question.
It's not income producing.
But I thought it said something about a trust or an SPV.
Oh, no, I said that. I added that.
Okay. Okay.
And it's not, the way it is just pure property.
Yeah, no, they don't want to know about your home, or even if you had a non-income producing commercial property in your individual name, which would be unlikely. But
so from your experience, the IRS usually approves this type of exception more often than not, or is it the other way around?
I think, as Christina said, I've never had it rejected. I've never had the IRS question it. But if you have the facts, I'm never afraid of an audit as long as you have the facts to support the position. Same thing with New York. If you have the facts to support your position, I mean, an audit's not a fun thing. It's expensive. It's time consuming. But if you're taking the position and you have a reasonable basis for the position, then answer the questions.
Lisa and Christina, thank you very much for really excellent and very practical discussions and pertinent, certainly to many people. And thank you all for joining. In observance of Passover and Holy Week, we will not have events next week. However, we will remain available for any normal business. Our next event is the Brazil Summit featuring Economy Minister Paulo Guedes and Bandeirantes President Gustavo Montezano on the 8th of April at 9:30 a.m. And we're doing this in conjunction with the Brazil-U.S. Business Council. Please keep an eye on your emails for updates. Again, thank you all for coming, especially to our members. For those who are not members, please watch the brief video that follows, and we invite you to join the chamber. In the meantime, stay healthy and in good spirits.